Okay, let's dive into this puzzle from October 2025. We've got this S&P 500, breaking 6,900 record highs. Just pure market euphoria.
Right.
And yet, the Federal Reserve just cut interest rates again, second time in a row, 25 basis points, setting the new range at 3.75% to 4.00%.
Yeah.
So how can the Fed be worried about jobs hitting the brakes while, your portfolio is yelling party time?
Well, it's fascinating, isn't it? Because the market isn't actually irrational here. This is what some are calling the great divergence of October 2025.
Mm.
It really shows a deep split, a bifurcation into two completely separate economies.
Two economists, eh?
Exactly. So our mission today is really to unpack why the Fed's acting dovish, why the market's euphoric, and show you they're basically looking at totally different things. The takeaway, your portfolio might not be telling you the whole story about jobs anymore.
All right, let's start with System 1, the Main Street economy. This is the Fed's focus, right?
That's their mandate, yeah.
They cut rates 25 basis points because they're worried about employment. They actually said downside risks to employment. So jobs are the concern.
And think about this.
Mm-hmm.
They did that even though inflation, CPI, is still sticky at 3.0%. And here's the kicker. They were basically flying blind.
Flying blind? What do you mean?
Well, that month-long government shutdown meant a total data blackout. No official job reports. So this rate cut, it was based on internal projections, anecdotes maybe, not the hard numbers we usually expect.
Wow. And that split within the Fed's committee, the FOMC, that tells a story too, doesn't it? A 10-2 vote.
Uh-huh.
But the dissents were on opposite sides. You had Governor Miran wanting a bigger cut, 50 points, more dovish.
Right.
And then President Schmid wanting to hold steady, more hawkish.
Exactly. So that 25-point cut feels less like a clear economic call and more like a political tightrope walk, maybe. A fragile compromise.
A compromise between, like you said, two different economic realities.
Absolutely.
Okay, so the Fed's grappling with a weaker Main Street. But if Main Street's shaky, why is the stock market going ballistic? That must be System 2, the AI economy. The market's focus.
Precisely. And this rally, it's definitely not broad-based. That's key.
Not broad.
No, far from it. That S&P 500 is almost becoming functionally an index of just a few huge tech companies.
Yeah.
The Magnificent Seven. They now make up, get this, 37.4% of the entire index's market weight.
Wait, 37.4% for 7 companies?
Yeah.
That's nearly 4 out of every $10 in the index. That concentration is, well, it's huge.
It's unprecedented. And what's fueling their rally is massive, real investment, capital expenditure, CapEx. It's the AI arms race.
An arms race.
Think about it. Investment in computer equipment accounted for, a staggering 92% of all U.S. GDP growth in the first half of 2025.
92%. So almost the entire growth engine of the country was just machines buying more machines.
Essentially, yes. AI infrastructure build-out.
And you see the split reflected in the consumer data too, right? Overall confidence might be shaky.
But if you slice it.
Right. If you slice it, confidence is actually rising for high-income households. People earning over $200,000. They own most of the stocks. They feel the wealth effect. But for households earning less than $75,000, confidence is falling. So the spending of the wealthy is kind of masking the strain on Main Street.
Which brings us to a really tricky point, the moral hazard. If the Fed sees high earners are doing okay, maybe even great, doesn't cutting rates just pour fuel on that fire? They're using a cyclical tool, rate cuts.
For what seems like a structural problem, AI displacing jobs, automation, that's not just a temporary downturn.
Exactly. And here's the unintended consequence, and it's critical. The Fed's move, meant to help System 1, Main Street,
is seen by System 2, the AI economy, as a green light.
Precisely. Or a FIPPUT. It basically gives them cheaper money to accelerate the very AI boom that's causing the job market weakness the Fed is trying to fix.
Wow. Okay. So it's like a dangerous feedback loop.
It is. And that massive concentration we talked about, the Magnificent Seven, it creates this huge single point of failure for the whole market. Even the Bank of England has warned about this systemic risk.
So you've got one system contracting, one booming. The market isn't irrational. It's just rationally pricing the part that's growing.
That seems to be the case, yeah.
So what does this all mean for you, the listener?
Well, maybe the big takeaway is you can't really look at the S&P 500 anymore as a simple, diversified snapshot of the whole U.S. economy.
Well, that's the crucial shift. And maybe here's the final thought to chew on. If the S&P 500 isn't tracking the broad economy anymore, should investors worry less about a general economic recession hitting everything?
And worry more about
a tech-specific earnings recession. What happens if that AI CapEx arms race, that 92% of GDP growth driver, suddenly slows down? That might be the new vulnerability profile you need to watch.